I don't know the kind, some Peruvian coffee or something. Boyki, I remember you. You're back. Listen, guys, we're going to be in London in July. Finally, it's going to be confirmed next week, but it's very probably going to be in Moorgate. I don't know if you know that place. It's quite central. And we're going to be lecturing for 2 days, 20th, 21st of July in London. Very big lecture. So if you have the chance to go to London and come over meet us, it's great. It's a free lecture. So I think that I can start whenever you want. It's already 5, sound is good. So today's topic is one of the real crucial topics. Really for trading, actually, there's nothing more important for trading than risk management. And we consider it actually the most crucial part. Okay, so we start. My name is Pablo Ortiz, and I have also a nickname, which is EA-Billionaire. So you can look me up under that nickname. Our site is not very good looking yet in English, allaboutexpertadvisors.com. And we are delivering these lectures now with FX Street. We've been doing this in other languages, Spanish, Italian, soon also in German with FX Street. And, well, today's lecture is actually the most important lecture. And it's a series of 3. I cannot do Thursday. I'll be doing the lecture of tomorrow. So we will reschedule the lecture of Thursday. It's a series of 3 lectures. And we strongly recommend that you do all 3 lectures. Otherwise, you can go to, we already have the YouTube channel ready. It's all about expert advisors. And we will put up the videos there. There will be also in FX Street and to this series, some of the 3 webinars, you should really recover the topics because they're very, very important. So I developed a method, as I told you in other lectures, I studied mathematical physics in Germany, in Heidelberg. So I come a bit from the numerical background, and I developed a method of 4 safety nets. I draw very badly, but I'm going to draw it here. So, and basically, you know these guys that are in the circus up there trying to jump from one place to the other, right? There's this guy here. He's trying to jump from here at very high, 10 meters high or 20 meters high from the bottom. What do you think of a guy, a trapezist, right? What do you think of a guy that's doing that without a safety net, without any protection, jumping, going from one part of the circus, from the left to the right, without any safety net? What would you think of this, guys? Tell me something, participate. Meanwhile, silly. Only silly, Paul? Well, he's suicidal. That's actually the only word I can have for this is suicidal. He's not risky. He's not crazy. He's not stupid. He's suicidal. He wants to die. Whether consciously or unconsciously, he wants to die. You know what? Majority of you guys trade like this. You trade like this. You're trading in a suicidal way. You have no safety nets. You have no protection whatsoever. So the first safety net, the first net, I decided one day after I was trading in this suicidal way that I'm not going to only make a method of 1 safety net, but that I decided I'll do a method of 4 safety nets. Just in case the first net breaks down, I still have the safety net number 2. Just in case the 3rd net breaks or the 2nd net breaks, I have the safety net number 3. And if all 3 first break, I still have the safety net number 4. And if I'm unlucky and all 4 break, then I die. But I have more chances to survive in this difficult market because trading is really, really tough. Whoever told you that it's easy, it's a liar. Okay, so safety net number 1, the net number 1, it's basically they're all risk nets. Okay, how much risk I can have? That's the risk per position. I'm not going to be talking about this today. I'm going to be talking about this tomorrow, very, very fairly in detail. Safety net number 2 is how much I'm going to risk per streak, per losing streak. A streak is a consecutive series of losses of trades or positions. We will clarify this tomorrow. What's the difference between a position and a trade? It's not the same. Many people use it instinctively, and that's a big mistake, actually. The third safety net, it's going to be the risk per maximal drawdown. I'm going to be talking quite a lot about it today. That's the value. That's the accumulated value of losses, and we will give you a very, very, very precise definition of that. And the safety net number 4, these three first nets were considering one trading system. And if I'm trading more than one system in my account of the same capital, I may have a risk for the accumulation or the sigma of all the maximal drawdowns of all systems together. That's the 4 safety nets method that I'm going to be explaining in detail in hopefully 3 to 4 webinars. When I come to London, I'm going to be detailing it furthermore. It's very, very crucial that you understand this method. It works. You have heard bits and parts of it somewhere, but you never saw it presented in this complete way. And it's very important that you understand that these 4 safety nets, they are dynamical, they go together, and they depend on our risk appetite, but there is a maximum level that they can risk not to touch bottom. Because beyond these 4 safety nets, there is just one thing. There's the bottom floor here, and that is death. Death. Death, not only of our capital, but many people don't consider when they lose an account, not only do they lose their account and this capital they had, they also lose their dreams. They also lose their psychology. They get bad anchors, bad emotions. And when you lose an account and you go too far beyond, you're dying in some way. Okay. And it's very, very important that we preserve ourselves as traders. Not only for the money, but for ourselves. So we start now. I introduced the 4 safety nets, and now I'm going to introduce the safety net number 3, which is the most important one of all 4 safety nets, because the whole method is based on it, and it depends crucially and most importantly on this safety net, the whole trading structure. First of all, I'm going to define maximal drawdown. You heard the word. I write it in a wrong way. I write it with double D. You see it. The spelling is not right, but I do it on purpose. It comes from drawing down. What do we draw down? We draw down the capital curve. But there is 2 types of capital curve. I'm going to show you now. And the point is when we talk about drawdown, one guy means one thing, another guy means another thing. And we're talking about totally different breeds of cat. And that's really an important problem. We have different possibilities here. We can be talking about the balance curve. It's also called the capital curve. That's the curve we have when we have closed trades. This is a curve that consists of drawing the capital. Every time we close a trade, we put a new dot on this curve. Okay? I'm going to show you later. I have screens for that. The other curve we have is the equity curve. That's basically in the moment how much the capital may be floating in our favor or against us. Okay, it's actually the curve of the capital we had when we closed the last trade, plus minus the floating we have now. That's called the equity curve. We could be talking, when we talk about maximal drawdown, the worst of both. Just saying, okay, whatever is worse in the moment. Or we could be taking definition number 3, which is actually the definition of MetaTrader, and many people don't know it. That's in the pit of the balance curve, in the pit of the closing curve of trades, we add to it the calculation of the negative floating, and that's going to be the addition of both figures. It's going to be my definition of maximal drawdown, at least of MetaTrader. I'm going to give you my definition later. So you see there's many choices here. It could be 0.1. One guy could be talking about equity. The other guy could be talking about balance. It's not the same. Or one could be meaning the worst of both. Or one could be meaning the MetaTrader definition. And it can be very, very different depending on how we trade. Especially if we trade in a risky way, in a crazy way, definition on balance and definition of equity may vary a lot. The next thing we need to decide and define is to what do we refer those figures? Are they relative to the value of the capital at the given moment? Are we talking, let's say we started an account with $10,000, let's say, or pounds or whatever. Okay, so the thing here is that we have here, for example, we started an account, and repeat that, with 10 grand. And what happened is that, sorry, there's a lot of screens coming in. And we were very good, and we managed to put it at 15 grand. And we went into drawdown. You see this, and the balance curve, we lost here, for example, 1,500, 1,450 to be precise on the balance curve. And additionally, the trade, when we were in the pit, you see this, the last point here. I don't know if you see my mouse. I think you do. Yeah, we had an additional trade that floated against us, and the equity curve was a bit lower. So it was $50. So it was 1,450 plus 50. That altogether would be 1,500. You see, that's the definition of MetaTrader. But what MetaTrader does, it calculates the 1,500 towards 15,000. And I don't agree on that. They calculate it on the actual balance. They say, okay, your drawdown was 1,500, so it's 10%. And I don't agree on that. For me, it's a 15% drawdown. And I'm going to explain you why, guys. Okay, you follow that? We had a drawdown of 1,450 on the balance curve. Additionally, $50 on the equity curve, the green point. So altogether was 1,450 plus 50,500, but we don't refer it to the upper figure, the actual balance. We will refer it to the initial balance, and I will explain you later why. Okay, so it's very important that we understand that equity curve and balance curve in MetaTrader, they're represented in blue, the balance curve, and the equity line in green. In my FX book, they're represented in dark orange, the balance curve, clear yellow, the equity curve. And you need to know that in my FX book, the points, the dots are daily, and in MetaTrader, there are trades. Okay, don't watch this at 25%. It's wrongly done, this back test. This is correctly done because this robot is working on open prices. But I want you to see here that here the equity is always below the balance curve. That's a scalping system. And in general, on a trend system, you see we have positive equity very frequently. Do you see that? There's a lot of trades that float in positive. Do you see that? Do you notice the difference between these two curves? Where the equity line is above the balance curve very frequently, and where the equity curve is almost always below the balance curve. That's more a scalping system upstairs. And here below, that's more of a trend system. Okay, so the point is we will take both, the worst of both. I will give you my definition now to draw down. That we understood that there's different ways to look at it at the drawdown. And it's very important that you need to be very specific and precise when you talk about drawdown. There's many ways to trick around and not to tell the truth about your trading account when you really don't have a clear understanding how to define drawdown. So I'll give you my precise definition of drawdown in my method. You will take the worst of both curves. So if the worst is equity, you'll take equity. If the worst is balance, you will take balance from the upper point calculated. This is missing here in the slide. Okay, and you will calculate it against the worst value of actual balance and initial balance. This means, let's say for instance, you would be, let me save the super image or whatever. I will destroy it later. Let's imagine you started with 10 grand here. You start always with 10 grand. It's easier to calculate actually. And you made here 15 grand. In this case, if the drawdown starts here, you will calculate towards the lowest of both figures, which means 10 grand. But if you started with 10 grand and you are losing, and let's say, for instance, you are at 7.5 grand, you already lost 2.5 grand, and you calculate here a drawdown, right? You need to calculate against the actual balance. you will always take the worst of both figures between actual balance, the balance you are having right now, and initial balance, right? So that you will always take the worst percentage calculation. That's what I mean when I say you need to calculate it in absolute value. And it's very, very important because now we'll come to a mathematical conclusion how much drawdown we can really afford. And many people don't know this. What is the magic figure you can afford on an account? And because of that, we need to have the precise definition on how to arrive to this percentage value. Okay, how are you doing, guys? How is sound? How is understanding? Is it clear? Okay, Paul is fine. And RC. Where are you guys from? Later, I would like to know a bit of time later to tell me where you're from. Okay, so you need to understand that maximal, yeah, that's great, outside London. You need to understand that drawdown in the future will always be worse than drawdown in the historical backtest, right? I mean, don't expect that the drawdown, I mean, if you leave the trading, whether it's a robot, whether it's your own manual trading, your future drawdown will always be worse than your past drawdown. Always. And because of that, you need to cover yourself in risk terms. So a very good way of covering yourself is taking my definition, the definition of our trading method, not out, in our trading method, that I'm spelling here. And I consider all other definitions of drawdown self-deceit. You understand? Because it's very easy to say, oh, I'm going to just consider it always to the actual balance, you know, because I'm always a winning trader, you know. Or I will take a robot which has the drawdown maybe in the last year, but it already doubled the account, you know, and if it doubled the account, the drawdown calculation will be how? So when it says that when you think you have a 10%, you're having a 20%. When you think you have a 20%, you have a 40% drawdown. Why? Because it can be that you start trading exactly the day before the drawdown. It can be that you start trading here. You see where I'm pointing? If you're very unlucky, you start this day to trade, or you start this trade to trade, and you exactly fall in the pit. So this percentage should be always calculated to the worst figure, right? Because this could be your 10,000, or this could be your 10,000, or this here could be your 10,000. Do you see that? If you only take the equity, you're lying to yourself as well. So you need to take from the highest point of the best curves, of the balance curve, to the lowest point of either one. You see the highest point of the balance curve of the blue curve to the lowest point of the green or the blue curve. And you see here that there's a little bit lower point here than here. So that's your drawdown. Your drawdown is calculated from here to here. It's not calculated from here to here, right? It's very important. Or it's not calculated only the green curve from here to here. This will give a lower figure. You'll take always the worst of the worst, right? Because it can happen that you're very unlucky, and it will happen. Okay. So once we have that, let's go to a back test. I just took very good back test. We have a lot of training systems. This is a very long back test. This is 14 years or 12 years long. From 1999, I don't know if you can see that, till 2011. Okay, it's done on an H-hour time frame, H1 time frame. The modeling quality is good. And what is very important is we start always doing the back test with 10,000, because 10,000 is 100 times 100. So it's very easy to find out percentages, right? Because when I have 100 times 100, in order to get percentage, I just need to move the comma twice to the left, right? If I divide 10,000 divided by 100, the only thing I need to do is to move the comma, if it was here, once, twice, to the left, and I just put a percentage sign, and I'm done. That's why we always normalize the back tests. There's more to this, but that's the basic, let's say. So if I have 10,000 capital, initial capital, and I made 29,596, I made actually at 295%. Over 12 years, right? Because I moved the comma twice to the left, right? 295.96%. My drawdown, MetaTrader says, you always read the back test like this diagonally. I'm going to tell you more about it in the next webinar tomorrow. But if you go here diagonally, you have your maximal drawdown. This figure is absolutely irrelevant. It's how much I lost, how much was the pit at the beginning of the curve. It was 2.73%. It's really irrelevant, that what they call absolute drawdown, besides it's misnamed. Okay, so that's basically how much I lost at the beginning. It was $200. I don't care about it. Neither I care about the relative drawdown, this figure that they have here at the end, because it's the measurement compared to the actual balance, what was worst. Why? Because I take always the worst of the situations, which is this one. I lost $900, to be precise, $911.50. By the way, I always do the backtest in dollars because the Forex market is denominated in dollars. I mean, the central currency still is the dollar. I don't know, in 2050, it's going to be the yuan. But right now, the central currency is the dollar. And if we have a strange pair that doesn't contain dollar, it will convert through the dollar. So it's important to do the back tests always in dollar. Doesn't matter if you live in the European Union and you trade in euros. Doesn't matter if you live in the UK and you trade in a pound account. You should always back test in dollars. Okay, just to make the story short, this 9%, like MetaTrader tells me 3%, and it's not true. It's 9% drawdown. You see that? By my definition. And this figure contains, which is probably here, or here, this is the drawdown actually. Because if it's 3%, it means that it's 1/3, so it already tripled the account. It's above 30,000. Do you see my logic? This is the maximal drawdown here. Do you see this small little valley here? That's the maximal drawdown. And it says here it's 3%. That's a lie. That's the part from MetaTrader I like. It's 9%. Why? Because I could be starting to trade exactly here in 2011 or 2010 or whatever year this is. And I could be exactly losing the $911 with my $10,000 capital. So that's a 9% drawdown. Do you follow? That's the safety net number 3. Okay? And it's always in the middle of the back test. Let's go to another back test. This is actually a trend system. Again, same game, $10,000. It made 218%. And I don't know if it's 9 or 14 years. I think it's a 9-year back test. I didn't put it in the slide. I can check it out. And it had a drawdown of 1695, which is 17% almost. I know you guys didn't have any idea about this. That's why you're here in the webinars. That's good that you're learning. It's very, very important that you really see the backtest in a real way, because many people lie about these things. You know, I can show you about grid systems, margin yields, how many traders that just want to sell the robots are lying with the backtests. But to make the story short, this guys is a 16.95% drawdown. Do you follow? Okay. And if you have a backtest which starts with 2,000 or 5,000, whatever, just calculate this divided by that in percentage. You follow? And forget about this figure, forget about this here, and forget about this here. I don't care if it didn't fall down here, great for it. It accumulated capital at the beginning. I don't care a damn what it did in 1999 or 2005. The biggest drawdown over all these years was 17%, and that's a very big figure. Okay. So if you understand the definition we have in our trading method, it's very important. I'm going to go to the core of the webinar of today. I still have 15 minutes. And this core, you really need to watch the video twice, thrice. You need to really, it must be really in your blood, really, because it's mathematics. You really need to understand that to go down is not the same as to go up. And you need to understand how much it hurts. So let's say for calculation purposes, it should be very easy. And if you want this document, by the way, I will give you our email. You'll get it for free. And you'll have the Excel. So you can check it. I would recommend it strongly. You would print it and you put it on your screen, on the side of your screen. And when you're trading, whether manually or automatically, when you reach a drawdown level, you know what you have to do. But this is the most important thing you'll ever hear about risk management and trading. And it's no bullshit. Okay, so let's say we have 100 pounds or whatever as a starting capital, and we lose 5 pounds. You see it here. We're down 5 pounds. The percentage would be 5 divided by 100, it's 5%. But the recovery, we only have 95 pounds left. So we need to, in order to recover, we need to divide 5 divided by 95. Do you follow? We lost 5 pounds, right? Originally we had 100 pounds. You know, and we lost 5 pounds here. So right now we have over 95. We don't have 100. And the percentage of recovery, 5 divided by 95. And that's not 5%. Okay, that's the formula. You see that? When you lose 10, we have 90 over. So we need to divide 10 divided by 90, and that's not 10%. That's 11.11%. You can continue to calculate the table for yourselves, but as you see here, to lose 5% cost me 5.26% to recover. To lose 10% costs me 11%, 11.11% to recover. To lose 15% costs me 17.65% to recover. To lose 50% costs me 100% because I lost 50 pounds. I need to recover 50 pounds on 50 pounds. That's 100%. I need to double my account to recover a loss of 50%. Okay, as you see that here, there is some colors here, which I'm going to explain now. It has to do with the exponential function. I'm going to explain on the third series of this lecture what we call the safety net number 5. It's on this part of the table. Forget about this part. Just watch only the 1, 2, 3, the first 4 columns, and forget about this 5th column. It will be in 2 lectures, okay? As I said, I cannot be this Thursday. I have a personal commitment, but I'm probably going to deliver this webinar next week with FT3. So the point here is that the losses are this blue line here. They're linear. Okay, when we go down, as we go down, it's linear, the loss, but the recovery is exponential. And if you remember, Einstein said that the exponential function was actually diabolic. You know, it had a very good side if you were using it in your favor, but it was very diabolic because humankind has a problem with exponential functions. We understand them mathematically, but we don't understand them emotionally. So if you see here, there's a point. This is like the hockey, whatever, that. And if you see here, there's a point of no return. It's called usually the tipping point. There is a very good book by Malcolm Gladwell. He talks about tipping points. He gives examples in New York, criminality, statistics, and other examples where there is a point of no return, or some diseases like AIDS when it spreads out, or stuff like that. All of these are exponential functions. And there's a point of no return, or also called tipping point. And I calculated personally this tipping point is between 22.5, maximum 30%, because they're already, you see the divergence, they're going down already very separate from the red line. Okay, so the point here is that actually it's 22.5%. When I lose 22.5% of my initial account balance, I need 29.03%. And you say, okay, it's not so much. But you know what? It's a 6.5% difference. And if you're trading a very good system which earns on average $20, which means 0.2%, $20 on 10,000, you will need 32 more trades, 33 more trades just to recover to the point you were in at the beginning. And that's almost impossible already. You see this? So the maximum drawdown you can ever have in any investment, and that's very important because people say, well, I'm actually trading in another way to real estate. Why? Why the hell? If you bought a townhouse and you spent, I don't know, 150,000 pounds, and the value of this townhouse is already 100,000 pounds, you already lost 33%. You're late for selling. You follow? Because the probability in the pit is that you will never go back upwards. You know, it happens with any exponential function. When the ratio of debt to GDP in the major economies, let's say in Greece, for instance, Spain, for instance, also, you know, Countries that are already over 100%, 80% is calculated as the tipping point in the ratio of debt and GDP. It's very difficult to recover, almost impossible, because it will cost you much more to recover. And as you go down, you need to trade with lower risk. You see, if you lost 10%, you need to trade with the losses should be 10% less. So how are you going to recover if you need more trades, but your trades are 10% lower in value? You see that? So the bottom line, you cannot risk ever more than 23% of your initial investment. Do you follow? If you started a trading account of £2,000, small account, and you are losing £460, you need to close the account. Period. You follow? Do you follow the logic? It's very important. There is no exceptions. There is no, I will manage. There's no such thing. If you don't understand the safety net number 3, if you don't understand the mathematics of it, please review the video. There is no way around. If you lost 23%, you're done with this investment, because 1% down is not equal to 1% backwards, back up, right? So we have here a semaphore, a trading traffic light here. Wow, I put it in Spanish. Sorry for that. I thought I had the slide in English, but you follow. When you lose 5%, you're yellow. When you lose 5%, it's quite easy to recover. You only need 5.26 to recover. Losing 5% in an investment is nothing. You really can't afford it. You only need one more trade to recover. That's nothing, right? It's doable, right? When you lose 10%, you need 6 trades more to recover. It's already orange. You know, this traffic light is a special traffic light because it has 4 colors, okay? And it doesn't have a green, okay? But 10% is already orange. It's already risky. When you lose 50%, you are, I want to say the coursing words, but you know what I mean. When you lose 15%, it's very, very bad. You're very close to 23%. And when you lost 20%, it's pitch dark for you. You follow? So that's a way of understanding it. It's not the same to lose 5% than to lose 10%. It's not the same to lose 15% than to lose 20%. So when we watch these two trading systems, and we go backwards here, and we see this trading system lost 17%, and you say, well, it made 218%. That's a very good percentage. It tripled the account, right? With a risk of 17%, global risk. And this one did 295%, and it lost 9%. You see even the curves? It's a completely different picture I see here, right? This might be a Picasso, right? And this is, I don't know, this is quite ugly. Still, it's very good, but compared one to the other, compared the earnings to the risk, for me, 17% is very far distance from 9% because it's not linear. You see that? So you need to have the idea that every 1% down costs much more than the 1% down before, right? When you're losing 8%, it's not the same than when you're losing 9%. It's much more expensive. And when you're losing 10%, it's much more expensive than the 9%. It's not just 1% more. You follow? It's exponential. The chances to recover are lower. The good traders, they just know how to handle the drawdowns. That's all about it. Institutional traders, they only watch the drawdown. You follow? And they know very precisely what the difference between a 15% and 10% and 20%. As a matter of fact, they wouldn't ever trade millions with 20% drawdown. They shouldn't. It's very bad. You see? Okay. So if you understood the safety net number 3, how are you doing, guys? Hello? How are you doing? To rerun. Yeah, that's good. You'll have the video. You can listen to it. We'll go over the same issues further. We have another safety net, which is the maximal losing streak. A losing streak is when you're really unlucky and you have one losing trade, you lose 10. Sorry for that. Another losing trade, you lose 15, for example. Another losing trade, you lose 25. Till you don't get a winning trade. That's a losing streak of 3. You see that? But I don't care so much about the number of trades that are losing, which in this case is 3. I care very much about the value that I lost consecutively. In this case, I lost $50 in a streak. You follow? 10 plus 15 plus 25. The losing streak is 50 in this case, right? So there is another safety net. That is the safety net number 2. Before I arrive to the maximal drawdown, I should be watching it. And I'm going to show you where you can see this in MetaTrader. You see this system, it's here, consecutive losses, you see? And you will take on this right part, the worst of these 2. In this case, they are the same. This means that I had 30 consecutive losing trades. I don't care if it's 30 trades, 21, 15, 50 losing trades. What matters here is the figure. I lost 8% consecutively. You see this? Because it's 7.91%. I just moved the comma 2 times again. So this means I lost 8% of my account out of 10,000 in a losing streak. That's the worst that happened over 10 years or whatever the backtest is. And in the other backtest, the losing streak is 5.27%. You see that? And now I'm going to put this in relationship to this safety net. You see, this is the maximal drawdown. The pit, the valley was 9.11%, and the losing streak, the consecutive trades that were losing, was 5.27%, right? You should never risk more than 2/3 of your maximal drawdown here. You follow? If the maximal drawdown is 9%, on the safety net number 2, here, consecutive losses, you see this here, maximal consecutive losses, 5%. 5% is less than 2/3 of 9%, right? Because 2/3 of 9% is 6%. So it's right. It's properly done. You should never risk. Why is that? Because this will help you to stop your trading earlier. If you're failing, why will we wait to lose the 20%, the 23%? If we have a bad streak, something is wrong, you know? Either your trading system is wrong, or the market is changed, or you're doing something wrong with your psychology, or your money management is wrong. But definitely, once you reach 2/3 of the maximal drawdown that you had in history, you have to stop trading. Okay, so that's another way of watching the safety nets. It's very important because we understood that we had the crazy guy here jumping in the circus from the left to the right, right? And in order for him not to die, or her not to die, we put already the safety net number 3, which was the risk per maximal drawdown. I wanted actually to use another color. Risk per maximal drawdown, right? And in order not to reach this, we put another safety net before that, which is the risk per streak. You see this? We will not allow more than 2/3 of the value of the maximal drawdown to be reached, right? So if we have here 15% as a maximal drawdown, what's the maximum we can risk in a losing streak? Who tells me that? It's 2/3. If the maximal drawdown in our backtest is 15%, exactly 10%. Who was that? MRC. What's your name, MRC? MRC is the nickname, right? Sama, exactly. So if you have 15% in the maximal drawdown, you cannot risk more than 10% in a losing streak. Very simple. If you have 9% in the maximal drawdown, what's the maximum you can afford in a losing streak? Don't tell me the answer, Sama. Let's have somebody else giving the answer. 9%. How much can I risk here? 6%, exactly. You follow? So now you understood the two first safety nets, more about the other 2 nets tomorrow, in the webinar tomorrow. But if you understood that you can never reach past 23% in the valley, in the accumulated losses, and you cannot pass here 15%, because if here is 23%, right? 23% divided by 3, I see there 24, right? It's very close. So it would be 16, right? 2 times 8 and 3 times 8, more or less, right? 7.5%. 15% in the losing streak, right? 15% here, 23% here, 15% here, 10% here, 9% here, 6% here, depending on what you have. But the maximum is 23, so the maximum here is 50, right? It's very important to put them in relationship. So there is another additional thing you need to know. So the guy's jumping back and forth there in the circles, and when he reaches or she reaches 23%, it's game over. It's really game over. You cannot keep trading. Circus is finished. The investment is a failure. Okay, and that's very, very important. You need to stop trading that trading account forever. It doesn't mean you will stop trading forever. It just means that that trading account is a failure. Okay. While if you reach the safety net number 2, if you reach your 15% on the streak, or your 9% or 6% as we calculate, or your 10%, you will stop trading for 2 to 5 weeks. Why? Because something is wrong, but the market will readjust, or your trading system will be fitting more the market. You follow? So in safety net number 2, we only stop 2 to 5 weeks. Okay, that's the stopping time. 2 to 5 weeks, right? And in safety net number 3, and follow these instructions. I mean, this will follow you if you keep trading the next 4 to 5 years. This will follow you in the back of your head. I hope so, right? And when you start losing and you reach 23%, I hope you remember this lecture, really. When you reach 23%, please close the trading account. Withdraw the money. It's a failure. No, you are not a failure. The investment is a failure. You follow? You need to withdraw everything. I'm serious. Okay? We'll talk more about that. But you should really have this clearly. Okay? So just to finish, if you have some questions, this is our new YouTube channel, all about expert advisors in English. Any questions, go ahead. We'll be most probably being in London. This is the email. We create a new email, which is this address. If you want to reach us, if you want the Excel file, just write us with your name, last name, well, the usual data, Skype address, how many years in trading, city where you're a resident, right? And I hope really to see you in London would be great. And please, we have 1 more minute. Questions. We have a course we deliver in Madrid for 5 days long. I would recommend you come first to London, to the venue there, and we'll have 2 complete days of a free course, and then you can decide whether to come to our trading room and be 5 full days. We have people from all over Europe coming over, so it's not a big issue, and it's quite inexpensive to rent an hotel here in Madrid. So but I would like really that you understand the safety net number 3, the email address, all about expert advisors. I go back to that. Here. All about expert advisors @gmail.com. Yeah. If you want the Excel file, we'll send it over between today and tomorrow. Hope to meet you tomorrow at 5. We'll be talking about safety net number 1. That's the risk per trade, risk per position. How much we really can risk per trade because they lied to us. I just advanced to you. It's not 2% the way they told us, and I will explain you why. And it's very important you come tomorrow as well. And if it was difficult, the video, just review it 1 more time. Yeah, I hope, I don't know, I think I will tell you. I think it's going to be up in 1 or 2 days, the video. Okay, so no more questions. Was it really clear why it's 23%? It's mathematics, because that's the tipping point. There is no way back after 23%. You see here, exactly 22.5%. The blue line and the red line, they split apart from each other. You're welcome, Jan. Okay, So guys, I hope it served you. Really follow it. It makes no sense if you understood it in your head, but you don't follow it. Okay? Really, just apply it. I mean, you need to be strict now. Okay? Thanks. Okay, guys. So I hope to see you tomorrow. And I hope to see you in London as well on the 20th and 21st of July. Take those 2 days free. I will confirm you exact hours and venue. It's going to be probably Moorgate in the center of London by next week. Okay? Thanks a lot, Adinda, on FX Street, and we'll be meeting tomorrow. That's great, Paul. We'll meet in person there in London. Have a good evening, guys.